Assalamu Alaikum everyone, welcome back to the channel. I hope you're having a great day. In today's video we are looking at two different companies. They're very similar in terms of business wise. They have been on my short list for a long time, or watch list. I haven't had the chance to look into more into more details of these companies, and that is what we're going to do today. The first company that we're going to look at is FedEx. This company is actually transports goods, so for example like packages. So you can, I'm sure you've all come across where you can actually send a package from here to wherever you want around the world. And they also work with a lot of companies, so they're not just normal consumers. They work with businesses as well to transport goods either by boat or by plane or by different basically methods. The company, the reason I'm looking at this company is, as you can see here, for the year they are down about 7%. Year to date they're down about 12%. For the last 6 months they're done about 15%. Just this month is done about 15% just this month, and the last 5 days about 11%. Just yesterday it was about 1% down. So I want to know what's going on with this company and just basically look at in their financials. And that's the first thing we're going to start with, is look in Yahoo Finance, look at the financials and see how things are. Just bear in mind, this company has benefited from the COVID situation. When COVID hit, this is one of the companies, everyone stayed at home, everyone was ordering stuff, and obviously who was delivering? It was basically this company and obviously UPS and other companies as well. So when you look at their financials, you will see a massive jump in 2020 and 2021. And the reason for that is because of COVID, okay? And the analyst expectation still is to grow basically the business to a total revenue of 83, 84, 85 or more. Now that is very unrealistic because we're now back to the office and all that side of things. Things are going back to normal. We might be ordering stuff, but we might not be ordering as much as we did initially. So $65 billion to 69, then 69.2, so it went down a little bit in 2020, but then $83.9 billion. And that is a lot to do with COVID, right? Definitely. And when you look at their gross profit, you can see it's kind of been consistent, and then you had a massive jump, and I wouldn't be surprised if we see a dip next year. And I think that is why basically the sales happening at the moment, because of what's happened in 2021 and because of COVID situation. Everyone expected this company to be hitting the same amount, but obviously that's not going to happen. Okay, when we look at their net profit, okay, so their net income, if I can find it, there we go, net income is 5.2, and it's been kind of consistent with what was happening before. But then 2020 it was 1.2, and then it was jumped massively 2021, and then now to last 12 months is 5.2% billion dollars. Now again, it's not a bad company, but obviously because of COVID, and it has nothing to do with the financials of the company, is basically the situation that we find ourselves in. So 13, again, when we look at the total current assets, which is basically what it tells us, basically how much asset the company has right now, and if anything happens to the company, will they basically go down if they don't have enough basically current assets to pay off the liabilities. So current liabilities of 13.6. When you look at the current assets on basically 20.5, so they've got enough money to pay that. When we look at the ordinary shares, basically they've stayed, shares issued, but for example, they've stayed the same in the last 4 to basically years, which is good. Okay, you want them to buy them back, but obviously you don't want them to issue more shares, so it's fine. And then when you look at their free cash flow, again, from negative to 123 million to again negative, and then last year, basically year and a half, basically $4.2 billion. So it's definitely heading in the right directions, but I think a lot of the analysts are not happy with basically how things went in the last, basically how things are going to be in the next couple of months. So current year about 10% growth, next year about 11%, next 5 years about 11.79%. Really good. I mean, this is good. This is double digits. That's all you want. And when you look at the analysts, so you've got 13 that say it is a buy, 8 that say it is a hold, basically strong buy, sorry, and overall is a buy. Currently trading $226 per share, lows of 205, 315 of average, and 369 when it comes to average. When we look at Morningstar, again, fair value of 245 per share, currently 226. So it's got a long way to go when it comes to that. Same thing again, tip rank and $311. These guys are normally very, I don't know what the word is, linear, I think, in terms of basically predictions, but obviously they use these analysts, the different analysts, and all of them apart from one, and there's one more, okay, they all think it should be basically a buy, and there's upside of 30%, 10%, 62%. Okay, this one is actually predicting UBS, which is one of the biggest companies, they're actually predicting $369 per share, which is 62% upside in the beams, and that was in the last 3 days. So last 3 days, and because of their earnings, that's basically what they're predicting, right? Which is very good. So this is more up to date than actually last 3 months, okay, which is some of the companies that we're looking at recently. So it's really good to see the fact that it's got a lot more upside in terms of price wise, and the company, when it comes to Yahoo Finance, let's look at simply Wall Street, okay, is actually undervalued about 31%, almost 32%. So they're thinking about $331 per share. So that is FedEx in essence. And final thing I actually want to show you is their dividend. So the dividend safety, and the dividend safety will be this about 64, because when you look at again, remember the dividend comes from the free cash flow. So they use this free cash flow here to pay that off. So if it was negative last few years, it's not going to be 100%, okay? So 64 is a safe. Anything above 60 is definitely a safe. Right, final thing I want to show you is the dividend. So you can see here is 1.3, that you get about $3 for every share that you own, and it's a payout ratio about 15, which is very safe. And then you get about growth-wise, the last 5 years of almost 16%. That's really good. I'm not sure if it's only for 1 year, but will be interesting to find out how many years they have grown their dividends. Right, now we can talk about the next company, which is UPS, or United Postal Services. Again, they are in the same industry. So again, in terms of delivery wise, as you can see, a year to basically date, the stock is about 11% up. So complete opposite of FedEx. 6 months, 17.5. 1 month is about 2.7 down. Last 5 days, 1% down. Just basically today, yesterday basically was down about, basically up about 1%. So as you can see, it's a different ball game. But when you look at the last 5 years, you can see basically it's basically up 72% in the last whatever years, right? They do have a dividend, so I'll talk about that for now. About 2%, so it's likely pay a slightly bit more. The payout ratio about 36%. 5-year growth of is not great, but it's actually not bad at all. When you get in that and you're getting basically that much growth every single for every 5 years, then that's absolutely fine. And they have been doing this the last 12 years, right? So now we're going to look at their financials, see if how they actually fare against the FedEx. So 65%, $65 billion, sorry, $71 billion, 74, and then 84, 94. You can see there's a massive jump, okay, almost $10 billion there, and then again another massive jump. A lot to do with what's going on with COVID, but when it comes to gross profit, 12.5 almost, 13, 15, and then 18. So it's heading definitely in the right directions. Now when you look at their net income, so about 4.9, 4.7, 4.4, 1 because of COVID, and then massive jump for the last trailing 12 months. Okay, now let's have a look at their balance sheet. Again, we're looking for the current assets against current liabilities. So assets of 20 billion against current liability of 17, so they have enough to pay off. And when it comes to basically their shares, they've actually they've reduced it actually, but then they've issued more shares this year. That's interesting. So they have reduced it. So it was 860 million and then reduced it a little bit and then reduced it a bit more and then issued more shares. That's very interesting. Right, and then let's have a look at the cash flow there. Again, similar kind of situation, but right now, as you can see, because maybe COVID was happening, is $7.9 billion in cash. Really good. Let's have a look at the financials in terms of the analysts to what they're predicting. So current year of 36, then 4.4, and then 15 for the next, almost 16 for the next 5 years. Now, when we look at the where there's a buy or hold, you can see there's only 4 basically strong buys and maybe 1 or 2. So you can see it's a buy hold at the moment. So majority of the people are going for basically a hold rather than a buy at the moment. And then as you can see, $188 per share, but the average is $217 per share. When we look at the union, when we look at the Morningstar, okay, 163, currently 183. So fair valued is way higher than where the current price is. So that tells us it's a little bit overvalued. 2 stars normally means it's a bit overvalued. But according to TipRank is 221 per share, the average they're expecting, okay, based on what these analysts have predicted in the last 4 months. Once they report their earnings, maybe that might change. Okay, it's mixed at the moment, so I will definitely think this is a hold at the moment, not a buy. Right, final thing we're going to look at is whether they overvalue. So they're slightly overvalued according to this, 186 against $188 per share. And when it comes to dividend safety, it's about 69, which is quite similar. Right, so my overall conclusion about these 2 companies is, like, I like FedEx better right now because it's way undervalued in comparison to UPS, but UPS seems slightly bigger. In fact, let me have a look at their market cap. So 163 billion for this one, and the other one, if we look at FDX, let's see, 160. So FedEx is way smaller company than actually UPS. So UPS is obviously a lot bigger. So that's very interesting. So this might have a lot more upside, maybe growth coming up, whereas the other one is kind of becoming that mature company. Again, that's just my opinion. According to the analyst, this one looks like a little bit basically undervalued in comparison to UPS. I've always wanted to look into both companies. Basically, UPS seems a bit more attractive to me, but I wouldn't mind actually buying shares of this company if things do keep going down, because at the moment it looks like it's actually gone down quite a bit since the beginning of the year, almost 10%. So if it carries on, then I might just buy a few shares and just hold it and see how that goes. But that's my opinion. I still haven't I don't have any. I've never bought them. I think I bought once UPS a long time ago, and then I sold it very quickly once I found out it was actually overvalued. But that is my take on FedEx and UPS. I hope you enjoyed the video. Thank you very much. Take care. Assalamu Alaikum.